Picture this, you built a nice chunk of equity in your home, and instead of just letting it sit there, well, you could use it like a financial Swiss Army knife. Friends, this is where a HELOC comes in. Hey everyone, welcome back to 2 Minute Tuesday, where I pull the curtain back on real estate concepts so you actually understand what is going on. Now, if you are new here, these videos in this series, well, these are made for first-time buyers, or frankly, anyone who wants a deeper understanding of how real estate really works. Now, if that sounds like you, do me a quick favor, hit that like button down below. It only takes a second, but it really helps this video get to more people and keeps this series going strong. And frankly, it helps the channel out, so thank you in advance. Today, we're gonna be talking about HELOCs, home equity lines of credit, and how they can be an extremely powerful financial tool when used wisely. All right, let's dive in. Now, HELOC, well, it's basically a revolving line of credit that uses equity in your home as collateral. Now, if your home is worth $800,000 and your mortgage balance is $650,000, you've got $150,000 in equity. Now, a lender might give you access to a portion of that. Let's say $75,000 that you can draw on as needed. It works kind of like a credit card, except the interest rates are usually much lower and the credit line is secured by your home. Here's where this gets practical. Now, a lot of people use HELOCs for big expenses like home renovations. Maybe you're finally ready to update that kitchen, or add a backyard ADU, or put in solar panels to cut energy costs down. Others use it for major life expenses like paying college tuition, consolidating high interest debt, or even funding a down payment on an investment property. Now, the key is knowing when it makes sense to tap into that equity and how to use it wisely. So for example, instead of putting $20,000 on a kitchen remodel on a credit card that's 20% interest, you could use a HELOC at a much lower rate. Now, the key difference is that a HELOC, well, you only pay interest on what you actually borrow, not the total amount available. Now, HELOC, well, typically has two phases: the withdrawal period, and then you have the repayment period. Now, during the draw period, you can borrow, repay, and borrow as needed. Think of this like dipping into your own equity piggy bank. Then once the repayment period begins, you can't borrow anymore and you start paying back what you use, similar like a regular loan. But beware though, HELOC interest rates can be variable, so your monthly payments might change over time. Now, HELOCs can be incredibly useful, but they are not free money. Since your home is the collateral, not paying it back, well, could put your house at risk. That's why it's really important, extremely important, to treat this carefully, just like you would with any other major financial decision. And while HELOCs can be great for the right situation, they're not the best choice for everyone. So if you're considering using a HELOC, talk with a realtor, your lender, and make sure this fits with your goals and your financial comfort zone. This is just one of those tools that can either make your life a lot easier, or it can create big headaches if not handled properly. And then of course, if you've got questions about HELOCs or how they work, or if you've used one before and have tips to share, friends, drop them down in the comments below. And if you happen to be looking to buy or sell in California, well, give me a shout. I'm a real estate agent right here in Orange County, California. Would love to chat with you. And friends, that is all I have here for you. Thanks again for tuning into 2 Minute Tuesday. Don't forget to hit that like button down below, subscribe so you don't miss any future episodes. And with that said, have an amazing week, and I will see you in the next video.